Massive inflation, and the Fed is getting out of buying bonds. Oh my goodness. What does that mean for the bond market? Wait, what? What? This can't happen. So let me share what this means here. So I posted this yesterday on my community tab on my YouTube channel, which you should follow. I post lots of stuff on the community tab. Lots are political, so be query, my friends, or query. Take note, be cautious, because when I post political stuff, it might offend your. Oh my goodness, you might be offended. Oh no. Anyway, so here is a screenshot of the 10-year Treasury, the close of COB yesterday. A lot of people are not understanding what's happening here. So let me just go back to share with you what's happening. All right, so inflation is bad for bonds. All right, so when we have inflation, everyone says, as rightly so, that's bad for bonds. So that means you should not have bonds, because what happens is the Fed then raises interest rates, and that's when the Fed is raising interest rates to deal with inflation, the price of the bonds drops. That's pretty common. It's common sense. No one would really disagree with that. The Fed's raising, the price of current bonds drops. It's a seesaw, man. Part two of this is that the Fed actually is one of the biggest, if not the biggest, purchaser of bonds right now. And they do that to keep the long-term interest rates low to, quote, stimulate, unquote, the economy. So the Fed, Powell, just yesterday, one of the reasons the market sell off again is because Powell was saying we're going to get out of the bond buying market. All right, so you take that huge demand away. What happens when demand falls? Prices fall. Just think about it just simply. In 2007, the reason the real estate market started to crash was why? We had too much supply and limited demand. If you think about just in your own house, right now, if you put your house on the market, all right, because there's not that much supply, and there's a huge demand for your house. What does that do? You can sell your house above asking, because demand is through the roof, supply is low over here. All right, now you flip that around, 2007 and 8 in the real estate market, demand was low, there's hardly any demand, and supply was high because a lot of people are trying to sell their house. When demand is low, the prices drop. Relative, it doesn't have to, I hate to say relative to supply, because at the end of the day, right here is where the equilibrium is. This is the demand. When the demand drops, all right, and the supply stays the same, the prices drop. When the demand drops and the supply drops, the price is at equilibrium. When the demand grows because the federal government is getting involved in the purchase of the bonds, the prices increase. And as a bond, as we talked about just a second ago, it's a seesaw. Higher prices, lower yields. Lower prices, higher yields. So what this would tell you is this should not happen. This is the yields dropping from basically, I don't know what that is, 1.68 or something like that right here just a few days ago to 1.44. That's the yield. The only reason the yield drops because the prices go up. Why are the prices going up when the federal government is basically, they're saying right now, they're telegraphing, they're getting out of the bond buying market. So they're saying we're not going to buy bonds anymore. That is a huge demand that's being eliminated, and yet the prices still increase. Why? That doesn't make sense. On top of that, everyone's saying they're going to raise rates because inflation is through the roof, and yet nonetheless, the prices are going up and the yields are falling below 1.5. That makes no sense. So if we look at actually the 10-year Treasury, let me just bring this up here real quick. I mean, this is not supposed to happen. There's a story behind this real quick that I'm going to share with you, but a client I'm working with yesterday, a real great person. All right, so right now, before the market is open, the yield is at 1.48. So the prices have dropped overnight. All right, so the yield was at 1.44. 1.44, now it's at 1.48. So the yield has gone up by 4 basis points. All right, so that's 1/25 of 1%. That's not much, but still the yield has gone up, which means the prices have dropped, but it hasn't gone up much. All right, so if we look at the 10-year, going back to, let's see here, it was at 1.65 on October 18th, 2021. Now we're 40 days since October 18th, and the yield has dropped by 20 basis points. So the yield has dropped 20 divided by 1.68, 12%. Can you say the prices have gone up a corresponding 12%? No, but at the end of the day, the yield has dropped by 12%. So whatever that equates to, the price has gone up. The bonds have gone up. It's not like in October we did not know the inflationary pressures were here. It's not like in October we did not know the Fed was going to get out of the bond buying market. We didn't. I mean, this is nuts, man. And yet the Fed is going to not only get out of the bond buying market, but they're going to slowly raise the rates on the short term in order to nip inflation, to whip inflation out, is what they used to say in the 70s. And yet, even with all that, people are still buying bonds? Doesn't make any sense. Well, let me tell you what's going on here. This is a 10-year treasury, government bond. I have no clue what the corporate bonds did. I don't mess with corporate bonds. So let's see what the 30-year did. The 30-year right now is at, let's find it right there, 1.81. Look at that drop. Oh my God, bring this back up. The 30-year has gone down from 2.4 in March of 2021 to 1.8. The 30-year has lost 60 basis points in 8 months' time. This is insanity. The 30-year is at 2.091 on October 18th. It's lost 20 basis points in freaking less than 40 days. No, what? Oh, why would that means the prices have gone up? Why would people be locking in long-term debt given the federal government is getting out of the bond buying market, they're saying, and given the inflation is so high, inherently they're going to say we're going to get smoked because we have a fixed income and a rising increase in cost. Other than they're saying deflation is actually the inevitable result of all this for the long term. I'm telling you, if you ever need proof of deflation, it's here right now. It's here. No one would be buying 30-year bonds if we thought massive inflation was run away. No one, and we thought the government was getting out of the bond buying business. No one would be locking in 30 years at 1.8. No one would be doing that for 30 years if they thought we're going back to the 1970s. No one would be doing that. But yet here we are. It doesn't make any sense. So let me share with you some of the comments here. Right here, my man Tim Severn. What are people expecting inflation to subside from the purchase taper? No rate increase necessary. Yes, long term is inflationary. And then this guy James said that's exactly what is supposed to happen. Because my comment is, well, wait, this isn't supposed to happen when inflation is coming and the Fed is getting out of the bond business. Weird, huh? And he said that's exactly what's supposed to happen. So I'm telling you what he thinks. He thinks the price is going down. It's not the price going down. It's the yield going up. And I responded to him. I said, no. Yields going down is exactly what is supposed to happen, eh? He goes, yields been going down for 40 years pretty much without interruption. That's absolutely not. See, that's not what's supposed to happen when inflation is taking off and the government's getting out of the bond buying. He doesn't know what he's talking about, sadly. Yields been going down for 40 years. So he doesn't know what he's talking about. This is exactly what's supposed to happen. When inflation's coming and the Fed is getting out of the bond buying market, James says yields have been going down for 40 years. See, he's trying to backtrack. He doesn't know what he's talking about, sadly. Now, my man Pete Caruso says I'm ignorant of what this chart means, so I just explained it. But here's what Susan said. Oh, dear. No, she said, did she get rid of her thing? She must have deleted it. All right, and that's fine. So that's fine. And I'm not bashing Susan. She made a good thing. She basically said the price is going down. People are getting the bond market, essentially. And that's not what's happening. So I explained to Susan what was happening. She goes, oh, sorry about that. No big deal. I just glanced at reeling from my 29% drop in my growth stock portfolio. Growth stock's gone down 29%? Okay. No worries. Susan. Commenting is appreciated as it helps people understand. All right, so anyway, she deleted. That's too bad. The point being is this is an indication of the bond markets getting crushed because of high inflation. So let me pause real quick. First, I had to look up, do we have a 29%? I mean, we got the VUG was down 1.4 yesterday, but I don't think we've had anywhere near 20. Nah, I don't know what you talk about. 324 to 316. I don't know. I'm not sure why she says a 29% drop in her growth stocks. I don't get it. Unless there's some stocks that she has that I'm not, I don't know, is Facebook considered a growth stock? What is Facebook? I thought Facebook, oh, Meta platform. Oh, boy. I'm not sure what, let's look at 1 month. I don't think that's dropped by 29%, has it? 1 sec, let's see what we got. Yeah, so Facebook, that's not 29%. So let's see, Tesla. Tesla. I can't get over this price of Tesla. It's insane to me. But hey, whatever rocks the world, man. That's not 29%. I don't get it. All right, so I'm not sure why she said 29%. But anyway, let's go to, as I always do, VFIIX, and we'll give an example of what happened for government bonds when markets are going against the bond market. They're raising rates. I tell this to people all the time. So we're going to go back to 94, 99, and 2008. So 2008, they weren't raising rates, but here we go. 94, the Federal Reserve was raising rates, all right? And the Ginnie Mae fell by less than 1%. But notice the following year is up 17% because they got out of the rate raising market. And people say, okay, it looks like we're stable. 1999, the Federal Reserve was raising rates and went down by, and by the way, a lot of people would say this is what cost the Democrats their congressional majorities. The Fed raising rates, the idea that cost them nuts. But anyway, BDSMA, 99, they're raising rates. The Ginnie Mae was up by less than 1%. And then the following year, as the rates raising stopped, it was stabilized at 11%. That went up to 11%, the rate, the year-to-date return. 2008, of course, when the markets were getting destroyed, Ginnie Mae was up 7 in 2007, up 7.22 in 2008 because what's called a flight to quality. And that's what's happening here, a flight to quality. When people get panicked, they buy government debt. That's what happens, flight to quality. And the exact same thing happened in 2008 right here with Ginnie Mae. It was up 7.22 because of everyone worried about losing everything, as they did, actually. 2013, I don't think they're raising, I can't remember, but 2013, the Ginnie Mae was down -2. That's it. All right. And that's it. That's all. 2018, I think they did raise a little bit. It wasn't up much. But anyway, point being is, even when rates are going up, is the Ginnie Mae government bonds may take on the chin a little bit, not much, and yet they still, the following year, they come back strong because as the rates stabilize, people get back into buying bonds. And yet the irony of this isn't what's happening here, right? Because they're talking about raising rates, and yet the rates are going down, which means the prices are going up. Let's just look at a long-term government bond right here. Vanguard long-term treasury fund was up 1.48% yesterday. That makes no sense. Why would people freaking buy long-term debt when everything is saying it's going to go down in terms of the interest rates going up and the government getting out of the bond market? It doesn't make any sense. So if you look at performance, we're just going to look at going back. Let's see, in 1999, 94, what look at? It was down 7%. Rates were going up, and yet it was down 7%, and yet the next year you're up 30%. 1996, that was irrational exuberance, I think, or did he say that in 95? Greenspan, I can't remember. But anyway, either it was around this time. 1.26 were down, next year up 13%. 1999, there's a long-term debt now. The rates were going up, the Fed was raising, it was down 8.66. Next year's up 19.72. 2008, up 22% because of the flight to quality. It gave some of that back in 2009, 2013, down 13%. It took it all back in 2014, gave some of that back in 2015. I mean, we're talking 1% there. Recaptured some of it. The next year recaptured some. 2018, when they're raising, is down less than 200 basis points. The next 2 years, see, this doesn't make sense. Doesn't make sense for the flight to quality other than, I mean, look, this would make sense that the government is buying it. I get that, but it doesn't make sense that there's huge flight to quality if everyone's worried about long-term interest rate hikes and inflation. That makes no sense. For what happened yesterday, up 1.48, makes no sense, man. 1990 was the recession. Leading into 1991 was a recession, and those were up 17.43. So even during inflationary times, it takes on a chin for a little bit, but then usually, historically, it's picked it back up the following year. Anyway, the point being is no one knows anything. And so when I hear these people saying it's inherently inflationary, I said, how do you explain that, man? How do you explain that? There's no evidence of that. So let me close up by saying I was working with a lady yesterday, and I get it. She's she was great. Her and her husband are fantastic, kicking butts and taking names up there in Wisconsin. And she was kicking ass, taking names. No other way around that. She did the right capital software in the top 5% of the people who do it. Is fantastic. Actually, someone like her should go into doing consulting on financial planning because she knows her way around the financial planning realm. It was just I love working with people like that. Anyway, point being is she had a bunch of money in a stable value fund. All right, and I like that because she's getting ready to hang up her boots. And I said, man, 100%. And I said, but then I can't remember, she could not do Roth conversions from her 401k. She's going to have to roll into an IRA. And I said, So I told her, I said, well, look at the Ginnie Mae fund because I just gave her the litany of what we just talked about with Ginnie Mae. I said the whole thing. And she said, well, I'm nervous about the bond market because, inflation's coming, they're going to raise rates and the bond market is going to get killed. And I 100% recognize her concern, 100%. And right now the Ginnie Mae fund is yielding actually, let's see, the last I checked, let's look at Ginnie Mae. I have no idea what I don't even know if Yahoo or will tell me, what it's yielding right now. So the last we're seeing is yielding 1.11. It's the last report. So I say, man, at least you're getting similar to a stable value fund. You're getting a government bond fund, 1.11. And if there is a recession coming down, which I actually believe there is, there'll be a flight to quality. Her concern was warranted in terms of she doesn't want to be in bonds simply because the interest rates going up is going to kill bonds. I said, I get that, but really no evidence of that happening in the government bond fund or really say anything for anything but a small fraction for a short amount of time. But anyway, her point was she just preferred being in money market. I get it. I 100% get that. I'm not here to argue that. I get it 100%. So money market's not going to pay anything. Ginnie Mae is only paying 1. Is it really that much of a difference to be in money market relative to Ginnie Mae? No. You're not getting a whole lot more yield for Ginnie Mae for the quote risk you're taking. There's not much risk. I mean, it's just a little bit of volatility. Just not much. But I get it. But the point being is her premise was somewhat flawed in that she's thinking that the rates are going to have to go up and thus the bonds are going to have to go down. I don't know that to be true. She could be, but historically has never happened like that. And as such, I think at the end of the day, a lot of people who are eschewing or just avoiding bonds because they're waiting for the rate increase. I actually think they're making a mistake because there's no evidence that there's going to be a rate increase that will affect the price of your bonds for any dramatic extent. None whatsoever. In fact, if anything, if we look historically, even a short-term decline in bonds has been replaced once the leveling stops, or once the increasing rates levels out. The price rebounds dramatically to make up what you've quote lost unquote. So anyway, just something to think about. Don't listen to these people who think they know everything. They don't know what the hell they're talking about. No one does. This is the issue. No one knows nothing. No one knows nothing. And all you got to do is say, look, I don't know. So be on both sides, man. It's okay to vacillate here. Got some money over here, like my lady up there in Wisconsin. It's okay to be in money market. I got no qualm with that. And she said the thing that is most important, this allowed me to sleep better. Man, if sacrificing a 1% yield right now allows you to sleep better because you're only getting 0.25, I'll take that any day of the week. Sleeping and health is wealth. So hedge on both sides, but no one knows anything. I'm just telling you right now. All right, love your thoughts. We'll see you.